Okay, let's unpack this. We're going to get into the deep mechanics of segregated fund taxation.
Hmm,
If you ever looked into these or you already hold one, you know you're in a place where investing, insurance, and some very specific tax rules all collide.
they really do.
So our mission today is pretty simple. We want to give you a clear, nugget-rich guide to how these funds are taxed at really 4 critical stages.
Right. Deposits, growth, withdrawals, and the guarantees.
Exactly. The whole life cycle.
And that map is so important because, and all our sources stress this, it is a complex area.
For sure.
We're laying out the framework here, but always, always remember the official advice. An investor should get specific tax advice from a qualified professional. We give you the rules of the road.
The professional helps you drive. A perfect analogy. And we absolutely need that framework because when you boil it all down, the taxation of seg funds really hinges on 2 fundamental ideas.
That's right. These 2 concepts basically structure our entire conversation today.
So what's the first one?
The first is just the tax status of the contract itself.
Yeah.
Is it taxable, meaning it's non-registered?
Right.
Or is it a registered plan, like an RRSP, RRIF, maybe a LIRA? Or is it something totally non-taxable, like a TFSA?
The tax-free savings account. And the second concept, this is the one that I think trips people up on their tax returns.
Wow.
It's the specific form of the investment income.
Ah, yes. Is it interest? Is it Canadian dividends, capital gains, foreign income? Because each of those categories gets treated very, very differently by the CRA.
Once we connect those 2 ideas, we can really track the money step by step. So let's start at the beginning. The money going in.
Your deposits, your premiums.
This part seems simple, but it already highlights a huge difference in cash flow for you, the investor.
It's definitely the easiest place to start. The rule is very clean. Any money you deposit into a non-registered segregated fund contract is not tax deductible.
That you're using after-tax dollars.
You are. You're paying your premiums with money that's already been taxed. And the same thing applies to a TFSA. You put after-tax money in.
Right, but the benefit there is that TFSA money is then tax-free forever. For most of the other major registered plans, though, the opposite is true.
It is. Payments into an RRSP or a LIRA are, generally tax deductible when they go in. That's the immediate tax break everyone loves.
That's the big incentive.
Yeah.
But even inside that registered world, there are some really important exceptions.
There are, and people often overlook them. Our sources make a point of highlighting that premiums paid into a registered education savings plan, an RESP.
Or a registered disability savings plan, an RDSP.
Right. Those are explicitly not tax deductible.
Now that sounds a little counterintuitive. They're registered plans, they're designed to help people save. So why no deduction on the way in?
Well, the reason is really in the mechanism the government uses to help out. For those specific plans, the government offers grants or bonds to top up the savings.
Ah, like the CESG for the RESP.
Exactly. So since the government is already putting a direct financial contribution into the account, they don't also offer the investor that upfront tax deduction. It's just a different way of subsidizing it.
That makes perfect sense. They subsidize the growth, not the deposit. Okay, that covers the money going in. Now let's move to the part that really complicates life for non-registered investors.
The growth phase.
Or, as it's called in the seg fund world, the tax on allocations.
And here's where it gets really interesting. This is where we see that fundamental difference between tax deferral and, well, immediate tax liability.
So the growth interest, dividends, capital gains, it can be earned in both contract types.
It can, but the reporting is just radically different.
Okay, so let's focus on the non-registered, the taxable contracts first. When the investments inside the fund generate income, that growth is allocated to you. Why is that word so important, especially when you haven't actually received any cash?
Well, what's fascinating is that the tax event is triggered internally. The insurer technically holds the units, but they allocate that income back to you, the contract holder.
So even though the money is just reinvested to compound?
Exactly. Even though it's automatically reinvested, the insurer issues a tax slip, a T3 or a T5, and you have to report that income on your annual tax return.
Which impacts your cash flow today.
It does, even though you never saw a dividend check or an interest payment land in your bank account.
So you could get hit with a tax bill on money you never actually touched, just because it was reinvested. That could be a real shock if you haven't budgeted for it.
It can be. And this reporting, it's also triggered by other things, like If you decide to switch between different funds within your non-registered contract, that usually triggers what's called a deemed disposition.
Meaning you realize a capital gain or loss.
And you have to report that annually too.
And this all ties back to our second fundamental concept, the form of the income. These allocated amounts, they're not all taxed the same way.
Absolutely not. And this is really the saving grace for the non-registered investor. If the growth is categorized as Canadian dividends or as capital gains, it gets preferential tax treatment.
Meaning a portion of it is excluded from tax.
Right. So you still pay tax every year, but you pay less on those specific types of income compared to, say, ordinary interest or foreign income.
Okay, now let's contrast that sharply with what happens inside a registered contract, an RRSP or a LIRA. The growth is still allocated internally.
But, and this is the key, it is explicitly not reported for annual tax purposes.
This is the core engine of tax deferral.
It is. The growth just compounds completely untaxed year after year until the money finally leaves the account. The government lets it build up tax-free because they know they're going to get their cut later on.
On the way out, that deferral is the key benefit. Okay, so we've covered inflow and growth. Let's move to that exit door. Tax on withdrawals and redemptions. This is where the deferred tax bill finally comes due.
And the differences here are stark. If you're withdrawing from a non-registered contract, you're redeeming units.
Right.
Since you've already been reporting the investment income annually through those allocations we just talked about, you're only taxed on any additional capital gain or loss that happens right at the moment you redeem.
And this is where we have to touch on that little piece of jargon that's so critical for non-registered plans.
Yeah.
The adjusted cost base. The ACB.
Thank you for grounding us there. Yes, the ACB is it's essentially your total investment, all your premiums, adjusted for any growth or income you've already reported and paid tax on.
Okay.
So when you redeem your units, your capital gain or loss is just the difference between the current market value
And that ACB.
and that ACB. You only pay tax on that final gain because you've already been paying tax all along the way.
That system is, well, it's logical.
Yep.
But the system for RRSPs and RRIFs, the registered accounts, it feels anything but logical. It's complicated.
It can be. When you withdraw from an RRSP or RRIF, the insurer actually retains a chunk of that withdrawal. It's a prepayment of tax.
It's called withholding tax.
Withholding tax. And this is where we see the most confusion. The insurer holds back anywhere from 10 to 30% of your withdrawal.
Depends on the amount and the province.
Right. It's just like the source deductions on your regular paycheck. It's an advance payment to the tax authorities.
But here's the detail, the head-scratcher detail that catches so many people. Even though the insurer already withheld tax for you,
Yes.
the full amount of that withdrawal, including the part they kept, has to be declared as taxable income on your return.
That is the crux of the issue. When you pull money out of an RRSP or RRIF, the whole amount is taxed as ordinary income, the same rate as interest income. The withholding tax is just a credit.
So you have to reconcile it
If
later.
you reconcile it later, if they withheld less than you actually owe based on your total income for the year, you pay the difference. If they withheld too much, you get a refund.
So the system is basically forcing you into this mid-year estimate of your tax liability.
It's a mechanism to make sure the government gets its tax revenue immediately. They don't have to wait.
And it shifts the burden of that reconciliation onto you, the investor.
Precisely.
Okay, let's narrow the focus even more to RRFs, the Registered Retirement Income Fund. Segregated fund contracts in an RRSP have to mature by the end of the year you turn 71.
And they are typically rolled into a RRIF at that point. RIFs were designed to make sure you eventually draw down those savings, so they come with a mandatory annual minimum withdrawal.
And that first payment has to be taken out no later than the year after you set up the RIF.
Correct.
And this brings us to what feels like a critical aha moment about RIFs and that withholding tax we were just talking about.
Yes, this is a vital detail for retirement cash flow. While tax is normally withheld on RRF withdrawals, the annual minimum RRF withdrawal is exempt.
It's exempt from withholding tax.
The insurer cannot charge that prepayment on the amount you are legally required to take out each year.
That is a huge distinction. So if your mandatory minimum for the year is, say, $5,000 and you decide to take out $15,000,
Tax will only be withheld on the extra $10,000, the amount that is in excess of your minimum.
Knowing that rule lets you manage your cash flow much better.
It does. You know you'll get that minimum amount without seeing a chunk of it immediately diverted to the government.
And before we move on, we have to mention the simplest exit strategy of all.
The TFSA.
TFSA.
It's the cleanest break. The money went in after tax. The growth was non-taxable. So any withdrawal you make is completely 100% tax-free.
No tax declared, no tax paid.
No withholding tax. It truly lives up to its name.
Okay, that covers inflow, growth, and standard outflow. Our final stage is one of the key features of seg funds, the guarantees. The maturity guarantee and the death benefit guarantee.
And the taxation here, it's very specific. It's limited to what we call the top-up sum.
So that's the money the insurer adds if the fund value is less than the guaranteed amount.
Right. Tax only applies if the market value of your units is less than what was guaranteed at maturity or at death.
So let's use a quick example. If your fund has a market value of $90,000, but the guarantee is for $100,000, the insurer contributes a $10,000 top-up.
And the tax applies only to that $10,000.
And how that 10 grand is taxed depends, yet again, on the contract type.
It absolutely does. If the seg fund contract is held on a non-registered basis, any top-up for either maturity or death benefit
Yes.
is taxable as a capital gain.
So you get that preferential tax treatment.
You do. But if the contract is registered an RRSP or a RRIF, that top-up sum is taxable as ordinary income.
Full income. It follows the same rule as any other withdrawal. In the registered world, pretty much everything that comes out is taxed at your full marginal rate.
However, there is one crucial element of tax deferral here, and it's a massive planning advantage.
Okay.
The spousal rollover. If the surviving spouse is named as the beneficiary of a registered contract, they can defer tax on that top-up sum by rolling the proceeds into their own RRSP or RRIF.
So they don't have to realize all that income immediately. That's a huge benefit during a very difficult time.
It is.
And of course, to stay consistent with our clean breaks, what about TFSAs?
Top-ups required for seg funds held inside a TFSA are not taxable.
Of course.
The beauty of that structure is that it insulates you from all these complexities.
So when we step back, what does this all mean for you, the investor, who's tracking your segregated fund contract? We've covered a lot of detail, but the big takeaway seems to be the same.
It is.
It's all about how the tax timing impacts your cash flow.
The crucial distinction, holding true across all four of those stages, is the difference between tax deferral on your growth versus tax allocation and immediate annual reporting.
Right. Non-registered contracts smooth out the tax burden over the fund's life, and they use preferential rates.
But they hit your cash flow every single year.
Whereas registered contracts offer that powerful tax deferral, that great compounding.
But they make sure that almost everything coming out is eventually taxed as full income.
And thinking back to the most complex part of that system, the RRSP and RIF withdrawal rules, that brings us to our final provocative thought for you to consider. The system of withholding tax on registered withdrawals. It's really designed to make sure the government doesn't have to wait until April 30th to get paid.
That's the bottom line. By forcing the insurer to retain that advance payment and then making you, the investor, declare the full gross amount for tax, the system guarantees an annual reconciliation process.
It's a structure that puts the onus on you to track what was withheld versus what you actually owe based on your total income for the year. It forces you to think not just about what your tax rate is.
But when you are forced to pay. And that distinction, especially in retirement planning, often makes all the difference. We hope this deep dive has helped clarify the roadmap for your segregated fund contracts.
Thank you for diving deep with us.